You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Thanks for tuning in to Mining Stock Education. I'm your host, Bill Powers, and joining me today is Randy Smallwood. He is the president and CEO of Wheaton Precious Metals. This currently is about an $18 million U.S. royalty and streaming company, so typically a company much bigger than the ones we usually talk about on the show. But these are the first movers. When gold moves, these are the type of companies that move first, and they're the most reliable investments in the mining sector. A low risk, high return possibility without 80% losses that we often can see in the exploration companies. I asked Randy to come on the show to talk about his company, but also the gold mining sector in general. So Randy, thank you for joining me for the first time.
Bill, real pleasure. And just a correction, it's an $18 billion company, not an $18 million company.
You know, you're correct. And I meant to say billion, but sometimes I think one thing and say something else.
That's just 3 zeros.
Yep. So, yeah, and if you were 18 million, you probably wouldn't qualify to trade on the New York Stock Exchange either, right?
Exactly right.
Yep. Okay, so in the gold mining sector, inflation is the key word. Oil price through the roof, supply chain issues. When you're talking to gold mining CEOs, what are their current thoughts on inflation and how it's impacting the sector?
Well, it's a real issue. It's been a real issue actually for a long time. The mining industry, when you look at the costs and just the costs of building operations, but also of consumables and such, all you have to do is look at the price of diesel, which is one of the biggest consumables in any mining operation, and look at how oil prices have changed. And so there's no doubt it is becoming a real issue. It is something that I know when we're doing our due diligence and looking at new opportunities, it is something that we really put a lot of focus into in terms of making sure that the companies have the financial capacity. It is one of the reasons that we always push for first and second quartile assets, is really just to make sure that the assets have the capacity to manage the impact of inflation and move their way, and still be profitable to all stakeholders. And of course, it's a real important aspect of it. It has to be profitable to all stakeholders, not just the streaming company, not just the operator, but all the other stakeholders around that also have to be able to thrive through that. And so inflation's a real issue. We're seeing good cost pressure on a lot of different operations. Any of the deals that we've done recently, we are monitoring it, and it appears that the operators have done a good job in terms of capturing that risk in their contingencies or taking measures to try and firm up prices beforehand. It's a matter of just making sure that we invest in high margin assets, because high margin assets will always survive or thrive the best through an inflationary environment. But there's no doubt, all you have to do is look at the raw consumables to understand that inflation is very real. It's been in the mining industry for a while, and I think the rest of the world is really waking up to it now.
So your company is exposed to the upside a lot of these gold producers when you buy or stream a royalty without the downside risk. But when one of the producers that you hold a royalty or stream on encounters some difficulties, do they ever call you and ask for help? How does that relationship work?
Well, to be honest, and I think if there's one thing that differentiates Wheaton, it should never wait for them to call us. We spend a lot of time working with our partners. There's a lot more to a stream than just signing the deal and handing over the cash up front. We visit the assets on a regular basis. We're in regular communications. We owe that to our shareholders. That's what we have to deliver back, is confidence in terms of how the operations are running and how things are moving forward, so that we can report accurately to our shareholders. And so it's a real key aspect of making sure that. So, if it ever gets to the point where they have to call us, that to me is a flaw in the system. We need to stay on top of these assets. We have an overlying mantra in our company: the stronger our partners are, the stronger we are. And so we are always looking for ways to try and add value and try and support our partners to become stronger. So if we see things that we're a little bit nervous about or concerned about, then we'll sit down and have those discussions. I've always said there's 3 ways we deliver value to our partners post the upfront payment. The first one is technical ambassador program, where we actually supply technical expertise at no cost to try and help our partners do better. Second one is, of course, our strong ESG programs or CSR programs, where we co-fund a lot of community programs around the mine sites. The first of the streaming and royalty companies, and by far and away the leader in that space in terms of actually delivering something back to the other stakeholders around the mine sites, our neighbors and such. So a very, very important aspect of it. But the third leg that we deliver value post the upfront payment is that unlocking value leg, where we're always looking for ways to try and help all stakeholders create more value. And so we're open to, it's one of the advantages, I think, of streams is that it's a contractual partnership. And so, we're always looking for ways to deliver that extra value. And if there's a way we can adjust the contract to help our partners be stronger in the long run, we'll gain from that too. So we're always looking for ways to deliver that extra value.
Randy, there was a recent survey of mining CEOs that were surveyed, and their greatest concern is ESG, not even inflationary issues in this environment, the report concluded. Now, there could be the good things about that, but also, as I talk to fellow retail investors, there's a lot of concerns, especially from the retail investor perspective, of some of the onerous and hindering aspects of a lot of the ESG requirements, to where like a mining exploration company is having trouble getting a permit due to increased demands from the ESG side of the business. From Wheaton's perspective, I know ESG is a big issue, but do you also see some of the hindering aspects of the current ESG movement and how the mining sector can advance?
Well, the ESG is part of sound business operation. I mean, but it does come down to managing expectations. And I really do think it comes down to education. A lot of communities, one of the things that the world does suffer from is a little bit of, I guess, for lack of a better acronym, NIMBYism. Not in my backyard. Everyone's happy to have the smartphones and the electric vehicles, but they don't want the mines in their neighborhood. They want it to come from somewhere else. And that's a real challenge. And I do think that society has to recognize that face it, the mining industry is pretty well the start of every supply chain. And if we're not going to support that, it just weakens the supply chain all the way down, makes things more expensive. And so, then it comes back to being responsible business operators and recognizing that there's more than just your shareholders that you're working for. At Wheaton, we've always focused on all of our stakeholders. Our shareholders, of course, that's who I work directly for, but our partners are also incredibly important. And even more important is our neighbors, where we get our social license to operate. And if we don't have that social license to operate, we're stuck in the water. We're stuck in the mud. It's not even water. It's stuck in the mud. And so I would say that, generally, and especially, the partners and the companies that we invest into, it's not, most of the ESG is just coming down to disclosure. Sound business practices have always involved good, strong support for community programs, around the mine sites, and recognizing that you need that strong social license. And now it's a matter of documenting, the efforts that I think good, strong business practices have delivered forever. And if you don't have that, it usually catches up to you. And so, we're always investing for the long term, which means you need to deliver some of those values back to the other stakeholders, to the neighbors, to the communities, and such. And I don't think it's ever a burden. I mean, if it's that problem where an asset can't deliver that, then perhaps you've got to go back and look at the economics. I think it's to the point where you just have to manage expectations and understand that, one of the challenges of all mining industries is so capital intensive, and so there's a huge capital risk, building the infrastructure and building the actual asset itself before you see any of that actual cash flow coming out of those operations. And so as long as communities and society itself recognizes that those long-term benefits will come through a sound and supported resource operation, again, it comes down to managing expectations.
From my perspective, particularly in the U.S. where I reside, there seems to be a disconnect on the energy front and also the resource front in terms of what the government is telling us we need in terms of copper production, nickel, uranium, all of these things, and then the policies and the ease of permitting. And I'm not arguing for hurting the environment or hurting local communities, but I just see a huge disconnect there. What's your take on the permitting risk, jurisdictional risk in my country, the United States?
Well, have you ever heard of a project named Rosemont? It's been trying to get a permit for over 20 years. And, from a Wheaton perspective, we do minimize our risk. We put in very little capital ahead of the permit itself. Usually the bulk of our capital always comes in after the permit is actually delivered. So we actually don't take the permitting risk ourselves. But nevertheless, the Rosemont project in Arizona, which, I believe the license plate says the Copper State. But the Rosemont project and now being called Copper World by Hudbay, and they're being forced to operate entirely on private lands in order to move this project forward. This is in a region that's got a long history of good, solid copper production. The area around Tucson in Arizona has got lots of historical, lots of history in the copper mining industry. And so I look at this and I see, one hand, the federal government encouraging, a shift towards greener environment and, a greener practices, moving towards electrification and such, all of which needs copper. And on the other hand, putting up roadblocks to allow a very well engineered, very well designed copper project to not proceed. And there's just a challenge with it. And as I mentioned earlier on in this NIMBYism, not wanting it in your backyard, but also wanting all the benefits of it, it's a real challenge. And society just has to recognize that there are going to have to be mines. We need mines. They are the start of every supply chain in this world. You need resources. You need resources even for growing, for agriculture. The minerals, the fertilizers that come from that, they all come from the earth. And so we, society has to recognize that there are places for mines and places where there shouldn't be mines. But when we select and identify an operation, we should, as a society, provide as much support as we can so you're not increasing costs, because generally what that means is a higher environmental impact. I look at the design that Hudbay has come out with on the Copper World project, where they're being forced to haul materials and store materials in square pieces of property only because of tenure. And I just think of the inefficiencies that are going to come into that. And those inefficiencies, you know what that is? That's extra diesel being consumed and pollution into the environment because of what? This project is going to go forward. It's a history of, it's in a region that's very proud. And so it is a bit frustrating that we see, the left hand talking about needing these materials and having to get stronger, especially from the United States perspective, and the right hand, putting up roadblocks to stop good quality, well-designed projects in areas that have history, mining, good, strong mining history. It is a bit frustrating, and it can't continue. The challenge is that every time you stop a well-designed, well-engineered, well-regulated project in a jurisdiction like that, you probably shift that copper production to some other area that may not have as high of environmental standards, may not have as high a regulatory framework. And, the world needs this product. The real world needs this material. So why not take advantage of the fact that you have an abundance of resources, select the areas that should be mined, and then provide as much support as we can so that we mine those minerals as efficiently and cleanly as we possibly can, and deliver a good solid product, a good solid made in America product. And Hudbay has gone a long ways towards that at the Rosemont project. They just released their PEA earlier this week, and they're even looking at refining the copper on site to have a truly made in America copper product. But the inefficiencies that are being forced upon them by this regulatory framework is embarrassing. It truly is embarrassing. Someone should step back and look at this and recognize how much extra waste is happening because of what Hudbay is being forced to do on this project.
Excellent answer, and I couldn't agree with you more. When it comes to Wheaton's ideal investment in 2022, can you give us some of the general characteristics of your ideal investment right now?
Well, we've been extremely busy. We've in the last year and a half, we've probably closed there's 9 different transactions on 8 different assets, put about $1.5 billion to work. And if you look at that collection of assets, there's a lot of single asset development companies right now. Commodity prices are strong. There's no doubt. And so anyone that's got operations in play generally is generating very, very good internal cash flows. But if you're a single asset development company that doesn't have operating cash flow coming into onto the balance sheet, you have to source capital somewhere to fund your growth. Debt is always available for good quality projects, and we are very, very selective about what we invest into. So generally, everything we invest to would be, lendable. But the challenge is the banks, the lenders will not fund all of the capital. You do need to supply that equity piece in terms of funding that growth to become an operating company. And what we have seen is a real niche for the streamers, and specifically for Wheaton, where we've had great success, is providing some of that construction financing on the equity side of the equation as these companies become producers. And very, very exciting, because what it has done is given us probably the strongest growth profile I would say in the entire precious metals industry, especially with the larger companies. This year we expect to do about 730,000 gold equivalent ounces. I think within 4 years we'll be well over 900,000 gold equivalent ounces, and probably getting pretty close to 1 million gold equivalent ounces within about 4 or 5 years out. We've got some really exciting projects that will be delivering production to us over the next few years. And that is our market. When we talk about 2022 and what we see, there's definitely still a healthy appetite for the single asset development companies to fund using streaming. It just makes incredible sense. Most of these companies are trading at PNAV multiples, price to net asset value multiples of around 0.2 to 0.4. Well below their net asset value. And so for them to issue shares into the market to fund the equity piece of it's very expensive to their existing shareholders, very dilutive to their existing shareholders. Whereas when they can do a stream on a non-core precious metals byproduct and get close to full value for that from a net asset value perspective, it just makes incredible sense. And so we've got a long list of companies that are lined up looking for additional streaming, and confident that we'll be able to add at least a couple more transactions this year.
A single asset developer, what's your time frame for return on investment? How long are you willing to wait for that return of cash flow?
It's different for every project. It always depends on project timing. Sometimes we will sign the deal before the permits are received, but we, of course, again, do not supply a lot of the capital until the construction is underway, which is after permits have been received. And so typically most of the mines are about 2 to 3 year builds, or some of them are even shorter than that. I know Rio 2 at the Phoenix project is a very short build. It's a very simple project, a nice simple heap leaching, crush and stack and leach. And so some of them are shorter and some of them are longer. Sabina's got the Goose Lake project up in northern Canada, which is a remote fly-in site. So logistically a little bit more challenged to get infrastructure in there, but the team is doing a really good job in moving that one forward. And so it's on track to be delivering relatively. So we're typically, most construction projects are going to be a 2 to 3 year period. We always factor that into how we value it. And, we're happy again, it is a relationship. And so we do spend a lot of time talking if there's delays or challenges or even capital needs. We're always happy to expand the stream. If there's we talked about inflationary pressures a bit earlier on. We expect to see that's going to be a continuing issue with respect to constructing new projects. We're always happy to, in any of these projects, they've all got capacity to expand the streams. And so it's nice that the operators know they have that support in their back pocket if it's required on a go-forward basis. But we're typically 2 to 3 years before we see production out of most of these assets.
You prefer a stream over a royalty then?
Streams are much better than royalty. First off, they generate a bit more value on a per ounce basis than a royalty does. Second off, they've got incredibly much more flexibility in terms of managing it. It's a partnership. It's a relationship between two parties. A royalty is just a registration on land. We have seen royalties disappear through bankruptcy process. So I think the rumor that royalties have better security, our approach has always been just invest into assets that don't go bankrupt in the first place, and that removes that risk. But the streaming, it's a contractual partnership that can be managed. It can be adjusted to unlock additional value. It's got so much more flexibility than royalties, and so. In fact, I think the industry believes that if you sit and look at it, nobody creates new royalties in the precious metal space. Generally, the only time you see royalties coming out, new royalties being created, is when its assets haven't had any success. There's no resource to be defined. It's basically greenfields exploration. In Canada, we call it moose pasture. And so that's the only time you actually see royalties being created. Streams have definitely, even the traditional royalty companies, they're all their large-scale projects, all their new projects are all streams. It just makes more sense.
Randy, when I go through the presentations of much smaller gold royalty companies, they lift up the exploration upside that they have exposure to. Wheaton's exploration upside with where you have your streams and royalties, can you give us a glimpse of what you have there?
Well, it's very good because these are life of mine agreements, and the bulk of our agreements don't have any drop downs or any significant. And none of our agreements have significant drop downs. We never had any drop downs more than about a third, and so we've already got. Well, I guess I can't say. I think I was going to say 60 years of reserves and resources, but you're not allowed to add inferred to measured and indicated and so on. So it's about 40 years of high confidence reserves and resources and another 20 years of inferred resources. And so again, one of the advantages that we have in the streaming business is that we provide in precious metals investors access to precious metals production from large-scale base metal operations. And that gives us a very unique perspective. What I would say is one of the best attributes of the base metal space is that because base metal mines are so capital intensive, they need very big resource bases before companies will commit the capital to building these things. Whereas in the gold space, typically much lower capital intensity, and therefore you only need about 15-year mine life before you're 10 to 15-year mine life before you're going forward on a gold mine. And so, what we get is the best of, I would say, both those worlds. We get the 60-year mine lives out of good, strong base metal operations, but it's from a precious metals perspective. We get the precious metals from these mines. And so here we are as a precious metals company with, I would say, the strongest reserve and resource portfolio in the entire precious metals industry. Good, strong growth going forward, as I mentioned earlier on, climbing very close to 1 million gold equivalent ounces currently, and with a few more transactions, likely over 1 million gold equivalent ounces annual production. Within the next 4 or 5 years is not unreasonable. We're well on a path towards that. From an exploration perspective, these are life of mine agreements, and life of mine on some of these assets is a very, very long time. And so we've had great exploration success. We've pretty well replaced, I think, every ounce, if not even, I think we're ahead in terms of ounces mined versus ounces discovered and added to the reserve and resource base since 2004 when we created the company. And so to be able to be sustainable in terms of replacing that exploration success and all the production that we're delivering back to our shareholders really highlights good quality mines always have, and again, focusing on high margin assets means that our partners will always preferentially spend more exploration dollars trying to expand and grow those resources. And so the focus on high margin assets is incredibly important in terms of running a successful streaming company.
So you have a lot of exposure to gold and silver. What about platinum and palladium? I believe it's about 10%, if I recall, of your portfolio. And are you looking to grow the platinum and palladium exposure of the company?
Well, we currently have palladium exposure comes from the Stillwater mine, operated by Sibanye-Stillwater in Montana. It's an incredible asset that's got 40 kilometers of strike length, and it'll be a mine forever. And so we get some palladium from that mine. And then the only platinum exposure we have is we've just recently signed a deal with Generation Mining on the Marathon project in Canada, and we'll be getting some platinum from that when it gets up and running. Now, they're still running through the permitting process. They haven't started construction yet. So that's probably going to be a good 3-4 years out before we see any of that platinum production. So from a palladium perspective, I actually think it's a little bit less than 5% right now in terms of revenue share. We do have some cobalt production from the Voisey's Bay operation. Vale's Voisey's Bay operation in Newfoundland, Canada, which I would argue is the cleanest, greenest, most environmentally sound, most socially responsible cobalt produced in the world. It's an incredibly efficient operation, a dedicated smelting facility down on the island of Newfoundland itself. That's a hydromet smelter, and all of the power being consumed there comes from hydroelectric energy. So a very, very unique product being produced in the cobalt world, and something that I know will unlock additional value as the world continues to get more and more concerned about provenance and where your metals and minerals come from. And so, altogether, a little bit of cobalt. We're not chasing the cobalt. This was a unique opportunity to work with an existing partner on a new project that they were trying to build, but we're not actually out looking for cobalt.
Did you get investor pushback on that when you announced it? Did investors give you a little pushback, like that deviated from what they thought they were investing in?
I think investors were more upset about the fact that, right after we announced the investment, cobalt prices dropped substantially. Now, we weren't taking any delivery until the start of 2021. That was when the contract actually started. So we signed the deal in 2018. And by the time 2021 came back, prices had rebounded beautifully. And so, we don't get any pushback.
Okay.
it's a nice little side investment. Prices have actually done very well for us in the cobalt space, and so we're not getting that. There was more concern about the fact that we made the investment, knowing long term that we were very bullish on cobalt prices, but it was at an elevated price back in 2018 when we signed the deal. We did use a much lower price in terms of valuing that deal than what the spot price was back in 2018. So, and Voisey's Bay is an incredible ore body that hasn't been fully explored by any means. They've got deep drill holes there that show that the ore body continues to depth, and they just haven't got to the point. It's because it's so expensive to drill deep. It's they're going to wait until they get a better platform underground to expand those reserves and resources. So it's a mine that's going to be operating for many, many years for us. And of course, cobalt is an important mineral. So, but in terms of mineral mix, we are focused on gold and silver. We started off as a silver focused company, but there's just not enough opportunities in the silver space. And so gold is definitely, when I look at the opportunity set in front of us right now, we're probably about 2/3 gold, probably about 20% mixed gold and silver, and then a little bit of silver, and the rare platinum palladium opportunity. We're very sensitive to political risk, which means that takes out a lot of platinum and palladium production.
So then if you look at a non-precious metals investment possibility, you just do so on a case-by-case basis. You're not actively looking beyond precious metals?
Yeah, I think it's more, we look at everything, but mainly it's more just to build up the knowledge base to understand what our peers are doing. We never really expect to step into those things. We're not chasing that stuff. And so therefore we're not bidding aggressively on it. And if we do wind up with something in that space, it's because we got a very good deal. And so, what we call, we'll put stink bids in on a lot of stuff just to keep our competitors honest. But we're not really pursuing any of that stuff. We're really focused on the precious metals. Again, first quartile, second quartile mines in the precious metal space. That's our real focus.
So at an 18 billion with a B US market cap, what is your greatest challenge to growth? How are you going to get to 40 billion US market cap? How do you do that?
Well, commodity price always helps.
Which you can't control.
Get gold up over 2,000.
Right.
No, I think the business model is a very sound business model, but never ever. We're not tied to always having to do transactions. There's times to make acquisitions, and there's times not to. There's times to reap from the garden that you have sown, and so we have to always maintain balance and make sure that it makes sense for us to make these acquisitions. We really do put a heavy focus on quality and recognize that what we try to provide at Wheaton is a very, very low risk way to invest into precious metals that still delivers all the traditional upside of growth, of expansion capacity, of commodity exposure. In fact, with the stream, it's leveraged commodity exposure because you do have that base production payment, which is fixed. You don't have any inflationary pressure on that production payment, but you still get leveraged exposure. And yet, From the risk perspective, we invest into high quality mines that have a long track record of delivering on their production. We always adjust our overall guidance to reflect our beliefs. And so we own our overall number. On an asset by asset basis, we'll always match our partners in terms of their guidance. But if you look at our overall number, it's typically about 10 to 15% lower than if you sum all the parts. And it's because that's what we believe. And we've got a really good track record of delivering on production. And so from a risk perspective, what we're trying to provide is the lowest risk way of investing into precious metals while retaining all the traditional high upside of the mining industry in terms of growth and expansion capabilities and leveraged exposure. And so we really do believe that this is the best way to invest into precious metals. And so how do we get to 40 billion? We continue looking for assets. We are blessed with an industry that is very capital intensive and does always need to find additional sources of capital. And so we'll continue to feed that industry as needed, but we're going to be selective. We do have a policy in our company of celebrating some of the projects that we haven't invested into as much as the ones we have. That's something to always recognize in terms of making sure that you have a good, strong, open environment that really allows some good critical analysis and give everyone a voice in terms of concerns and such like that, and make sure that we make wise investments. And when I look at the world, I really do think that gold is going to be even more important on the financial spectrum when I look around at what's going on in the world. And so I'm confident that we'll get there on commodity price alone, but we're going to add growth to that.
All right. My last question, internally, when your team is looking at the gold price and the silver price, can you give us like a 3-year projection, maybe some of what you're anticipating in terms of the commodity price or the gold and silver price? Some people don't like when you call gold a commodity.
Well, and as chair of the World Gold Council right now, I'd probably, I really do hesitate. I mean, I always answer that with higher, right? It's just, if you sit and look around the world at hard assets and something like gold, where it's getting tougher and tougher to find the ore bodies, it's getting tougher and tougher to permit the ore bodies, to build these, the capital costs, the infrastructure, it's getting more and more challenging. It's a limited asset that has limited accessibility, and then you measuring the value of that asset. Currently, we tend to value gold in US dollars. We measure how many US dollars up against that. Well, the US dollar is by far the strongest currency in the world. There's no doubt about that. And it is going through some real strength here of late, especially relative to other currencies. And I always encourage everyone to when you look at gold and maybe you're upset that gold isn't performing as well as it should be in US dollars, go look at it in other currencies around the world. It is actually doing quite well in other currencies around the world. And it's the fact that the US dollar is so strong. But is that where you want to, do you want to really ride, do you have that much confidence in the US dollar? And there's just so many fundamental challenges to continued strength in the US dollar and in fiat currencies. Right now, I think it's the best of a bad bunch of apples. And that's why I do think gold is going to become incredibly more important. And so in terms of forecasting, I will tell you that when it comes to us making investments, we will never pay a higher price than the spot price, because as much as I've been in the gold industry now for 30 plus years, I still can't tell you what the price of gold is going to be tomorrow.
So what are you using the calculation, like a 2-year trailing average, or when you do your economics?
We typically start at the spot price for gold production today, and then we drop to a long-term price that's anywhere between about 70% to 95% of the spot price, depending on where we feel we are in the cycle. Currently, we're using 85 to 90% of the spot price as a long-term price. And we adjust that based on the spot price. If it was $2,100 today, we'd be starting at $2,100 for gold. If it was it's around $1,850 right now, and so our long-term price, and we can't really vary much from that. Where most of our flexibility comes from is where do we feel we are in the cycle, and we do think that there is some optionality to the upside. And so the commitment back to our shareholders, of course, is we will not make investments based on my belief that gold is going higher. I'm not going to risk my shareholders' capital that way. Our approach is to make accretive acquisitions based on the current framework of gold prices, so that I can promise to my shareholders that we will deliver on a good quality operating asset that's got a successful operating track record, high single-digit returns, and if it's a development project, low double-digit returns, assuming a flat commodity price. And if we see upside in commodity prices, then that just adds and compounds the returns back to our shareholders. And to date, we created this company back in 2004, and we're averaging about 20% back to our shareholders. And so, that's been very successful for us to give that foundation, that base investment thesis where you are delivering reasonable rates of returns, but then you get the exposure to precious metals.
Yeah, it's been impressive what you've been able to do. And nobody can argue with the wisdom of your model of business, the royalty streaming model of business. But I got to throw in one more question as you were talking. So sorry that I said that was the last question, but you have so many junior mining speculators. Thousands of junior mining speculators are listening to us. And I invest in companies from $5 million market cap, usually up to about 100 million market cap. So you're in a total different league. But for someone like me and the thousands of listeners that speculate in these smaller junior miners, what would be your parting advice or words of wisdom?
If you've got a Wheaton stamp of approval on that, you've had a very, very critical analysis. We invest into a lot of companies that have market caps in that range. And so if you've got a third party like Wheaton, that especially Wheaton, where we really pride technical due diligence, we really put a lot of focus on that, and we have very, very strong teams in that front. Those are some of the hidden opportunities. The reason that they're doing streams with us is because they're undervalued relative to net asset value, and the reason that we're doing streams with them is because we believe in these projects. We think that these are good quality projects. And so if you see Wheaton doing a stream into Sabina or Generation or the reason we're there is because these are sound projects that will be mines at some time in the future. And I think that has to give you more confidence in terms of making that investment. And so, watch what we do. And I think that's a pretty good indication of where we would recommend investing.
Excellent. Well, thank you for your time, and thank you for joining me today, Randy.
It was a pleasure. Thank you.